Hello class, my name is Neil Ferrari. I'm the course director for business accounting. Depending on how many sessions we have this month online, I may not be your direct instructor. However, I'll provide some contact information for you, so if you need to get in touch with me, you certainly can. Let's go ahead and get started. First of all, here's my contact information. My email address is nferrari@fullsail.com. My cell phone number is listed there. You can always call that, and if I don't answer right away, leave me a message. I'll be happy to get back with you. One thing to keep in mind this month, and there's an announcement on the platform, but you need to get access to some software called QuickBooks. And the way you go about it, if you follow the link that's in the on the platform, is going to take you to a place where you can request a login for the software. Keep in mind you need to do that as soon as possible because it may take 3 days before QuickBooks gets back to you. Once you get the login, then you'll be able to access the program. The program is online, and as a consequence, some of the videos attached to the assignments may no longer be accurate, and I'll address that each week. How to succeed in this class? First and foremost, read the assigned material each week. That's going to provide the basis for you to handle each week's lesson. If for some reason you need some additional help, ask for it, and I'll be more than happy to set up a GoToTraining individually or talk to you on the phone as the case may be. Watch the GoToTrainings. There's one out there for each week. It tells you how to do things in QuickBooks. In addition, on each assignment, there are videos attached. Whatever you do, make sure if you don't understand any concepts, challenge me to turn around and explain them in better detail for you. So, let's do a brief history of accounting. People think accounting is relatively new, but it really isn't. It really dates back in some form or another all the way back to before the Egyptians. The Egyptians probably were the first more or less organized system. They had some auditing systems because their empire was so large that it was necessary for the Egyptians to keep track of things. So they had an auditing system. It was the Romans, though, that really kind of started accounting in any sort of detail. The Romans had a huge empire. They collected taxes. They had all sorts of funds flowing into Rome and so forth. And so they needed detailed financial information, and they developed a system to do so. It really wasn't until the 1400s in medieval Europe that accounting as we know today, double entry accounting, got started. This method requires a minimum of 2 parts to every transaction being recorded. We still use this method today. In the 1800s in England, there was an organization formed to kind of formalize accounting a little bit, and it set some standards for behavior, set some standards for how to go about the process of doing audits and so forth. From that, several major accounting firms came into existence. You can see them listed here. Most of these firms are still around, although some have merged and so forth. So for instance, Price Waterhouse and Coopers & Lybrand merged together. It's now known as Price Waterhouse Coopers. Ernst & Winnie and Arthur Young merged together. It's now Ernst & Young and so forth. The only one that's not around in some form or another is Arthur Andersen. And the reason for that is that they were involved in some accounting scandals in the 1990s and early 2000s. And as a result, the partnership totally dissolved. So, in accounting, there's 4 main parts: financial accounting, management accounting, auditing, and taxation. And what I wanted to do is go through each of these briefly to give you an idea about the background. Your reading is going to help you in more detail. Financial accounting. The focus here is on reporting financial results. And the way this is done is recording transactions and creating financial statements. The primary users of this information are investors, hopefully, lenders, and of course the US government requires publicly traded companies to report on their financial results. If you're a publicly traded company, you are required to follow some rules. And those rules are called Generally Accepted Accounting Principles, or GAAP. This is not an option. If you're publicly traded, you must follow these. They're very detailed, they're very complicated, and that's why you need the help of a CPA to make sure you're doing things correctly. The thing about financial accounting is you're looking into the past, not necessarily the future. By this I mean you have recorded transactions that recognize business dealings of the company, and the end result is you're creating some financial statements. All right, this information is all in the past. Management accounting looks towards the future, and we'll talk about that next. There's 4 basic financial statements: balance sheet, profit and loss statement, statement of cash flow, and statement of stockholders' equity. The balance sheet represents things that the company owns, those are called assets. Things that the company owes, those are called liabilities. And then the net worth of the company, which is called equity. Some examples of assets would be cash, best asset of all, maybe inventories, maybe computer equipment, and so forth. Some examples of liabilities would be things that you owe, such as maybe a bank loan or a credit card balance or payroll that you owe your employees. Equity accounts basically consist of stock and an account called retained earnings, which is the accumulation of all your profit and loss over the years. Your profit and loss statement has 2 things on it. It has revenue and it has expenses. Revenue would be your sales. So if you're a corporation like Apple, you might break that down into some detail, maybe by product line, maybe by geographic area. Your expenses are your costs, and some of your expenses might be payroll expense, interest expense, cost of goods sold, maybe rental expense, and so forth. If your revenue exceeds your expenses, then you have profit. If, on the other hand, your expenses are greater than your revenue, then you have a loss. The statement of cash flow. This statement shows the flow of cash coming into the business and the flow of cash going out of the business. It's a relatively new statement. It only came about in the mid-1980s, and it came about because a number of very large companies were going bankrupt. Even though they showed very strong balance sheet in terms of assets, they also had a lot of debt, and the companies were not producing sufficient cash to pay that debt. So the statement of cash flows came into existence primarily to show cash coming into the business and cash going out. Because of how we use accounting, we use a method called accrual accounting that allows us to record transactions before cash changes hands. So for instance, if I make a sale and the people I'm selling the product to promise to pay me in the future, I have a sale and I can record it as revenue. If they never pay me, then I obviously don't have the cash. Same thing with expenses. If I get a utility bill in the mail, I'm going to record it as an expense, but I don't necessarily have to pay it for 30 days. Statement of stockholders' equity. This is a statement that simply details the equity section on the balance sheet. It takes it into a lot more detail, and it shows individual transactions such as the sale of stock or perhaps the recording of the profit and so forth. So financial accounting deals with things that took place in the past. Management accounting, on the other hand, is really focused on decision making. In order to make good decisions, you need to have good information. And what management accounting does is basically provide that information. Now, it's not to say that financial accounting does not provide good information. It does. But sometimes management needs to have information that's not necessarily financial in nature. The key characteristics of management accounting are measuring performance, analyzing results, and reporting. What you're attempting to do is to achieve the goals of the company. And the only way you can do that is having a good system of information to make your decisions on. There is no requirement in management accounting to follow any rules at all, so GAAP does not pertain. The only real rule is that the cost of the information you obtain to make decisions can never exceed the amount of benefit. And it wouldn't make any sense if you spent $20,000 to come up with information that's going to save you $10,000. Well, that doesn't really make any sense. The focus here is on the future. You are basically learning from the past as far as performance, but you're really focused on what's going to happen in the future. You're going to use both financial and non-financial information. So for instance, financial information might show a record of sales and expenses. Non-financial information might be work schedules. It might be research and development plans and so forth. So you basically are coming up with information that you can report either by profit or geographic area or by department and so forth. The most common example of management accounting is doing a budget. We're going to talk about budgets in week 3, but budgets are essential for a business. It provides a roadmap as to where you're heading and what to expect in terms of revenue and expenses. Cost analysis. You cannot possibly come up with the sales price for your product unless you know how much cost is associated with that product. If you know how much cost is associated with the product, then you can set the sales price at the appropriate level. Customer data. If you have a very vibrant business, then you're going to know a lot about your customers. You're going to want to know, for instance, where I worked with Scholastic Book Fairs before coming to Full Sail, and this company put on book fairs at elementary and middle schools. One of our databases was on the individual schools. They would have a demographic of the students that were there, number of students, number of faculty. It would have information, for instance, like whether or not the school was a single story or multi-story, whether or not there was an elevator in the building, where the library was, which is typically where the book fair is held. This information was critical to running the business because, for instance, if you delivered a book fair with these big, heavy bookcases, and you get to the school and you find out that the library is on the 2nd floor and there's no elevator, then it's going to be very difficult to get the book fair cases up to the 2nd floor. Political data, very important. For instance, England is leaving the European Union. Okay, if you had plans to open a business in England, then you need to take into consideration the fact that things may not be as easy as you anticipated. Information about your competitors, absolutely critical. It's no surprise that the various grocery stores send people into their competitors to find out what pricing is, and you find in the grocery stores you frequently will see a cost comparison and so forth. So knowing your competition, very important. All right, auditing. Auditing is the 3rd main branch of accounting, and there's 2 parts to it. There's external and internal auditing. External auditing is focused on the financial statements, and an external auditor is someone the company hires to come in to review the financial statements and to render an opinion as to whether or not the financial statements present fairly the financial condition of the company. Now, that's critically important because if you're an investor, you don't want to invest in a company by buying their stock blindly. You want to be able to take a look at their financial statements to know how they're doing. Same thing with banks. They're not going to lend you money unless they have audited financial statements they can look at. The thing about external auditing is that you're looking at things that have already happened. Now, the reverse of that is internal auditing. And internal auditing is done by employees of the company, and it's focused on two things. One, safeguarding assets. So you want to make sure that the company, if any fraud's taking place, that you can detect it and then correct it. Improving operations. Okay, oftentimes internal auditors are asked to go look at a portion of the company to see if they can make recommendations to improve the performance. All right. The main thing to keep in mind is that auditing is independent. External auditors and internal auditors both report to the board of directors and primarily to the audit committee, which is composed of outside directors. They are not reporting directly to management. Okay, that's an important distinction. And that brings us to our final section of accounting, which is taxation. Now, this class is not going to be about taxation. However, taxation is very important for corporations. For instance, if you have a corporation, if it's set up as an LLC, then all the profit of the corporation is going to pass through to the individual owners, and therefore the owners are responsible for the tax. If it's a more traditional corporation, then the corporation is responsible for the tax. The tax code itself is incredibly complicated, even though they just put through some revisions in Congress in this past year. It is still very, very complex. And most individuals choose to use a third-party software, TurboTax is an example, to do their individual tax returns. If they have a more complicated tax return, they might hire a CPA to prepare that for them. Corporations are no different. Corporations turn in, they have very complicated tax returns, and larger corporations have their own tax department. And these folks are responsible for making the corporation pay as little tax as possible. We're not going to talk about taxation after today. Just keep in mind that it's a huge area for corporations. All right, one final thing I wanted to talk to you about is Assignment 1. Assignment 1 is going to be done in QuickBooks. It is three parts to it. The first part is vocabulary. You have a listing of 15 accounts that you would commonly find on the balance sheet and profit and loss statement. And you're going to be asked to define each of those, and then also to name the financial statement each account would be found on. Part 2, you're going to create a company in QuickBooks. And when you create that company, you're going to be asked to add the 15 accounts you just defined to what's called your chart of accounts. And then finally, part 3, you're going to do one transaction. And that transaction is to record the issuance of stock to the president of the company for $20,000 in cash. You'll be doing a journal entry to handle this transaction. I hope that this quick overview has been helpful for you. I will be doing one for each week to talk about that week's assignments and lessons. And reiterate again for you, if you have any questions whatsoever, you simply need to contact me, and I'll be more than happy to meet with you either by phone or in a go-to training and try to answer whatever questions you have. Thank you for taking the time to listen to this. Goodbye.